Here with Dom Guiliano, Portfolio Manager at Magellan Financial Group. Thanks for joining us today, Dom. And we're talking about America now. We've been around the world so far. And theoretically, America's going to finish their money printing program later this year. Well, that's what's expected. Are you able to give us an update of where that, which is commonly known as Quant Easing, can you give us a fly overview of where that program's at and what some of your likely expectations are from here?
Right, so
that's a tough question for you.
No, not at all. So the Federal Reserve has been quite clear about its intent to phase down the quantitative easing program over the next couple of months. So we should probably see new purchases of securities come down to zero, certainly by the end of the year.
So they'll stop buying?
They will simply stop buying. They will still have a very large balance sheet.
Yes.
Of purchases that they have made, and we're talking about 2.4 trillion, that kind of number.
Yep.
But they should be able to keep that balance sheet under control. The next step really then becomes one of normalisation of monetary policy.
Right.
So the Federal Reserve has been flagging in a number of different ways that short-term interest rates might move up from zero to something.
Yes.
Over the course of or beginning sometime next year. And there's a lot of speculation. Is it going to be the second quarter, third quarter, first quarter, fourth? Like, we don't know, and really we don't care so long as the direction's a good one. And we expect, given the positive fundamentals that you're seeing playing out in the US economy,
the
strength,
employment and economic growth.
Exactly. The economic growth continues to show positive indications. Unemployment continues to decrease, which improves household wealth. Propensity for households to buy is improving. Number of houses sold is increasing. House prices are increasing. Business investment is slowly increasing. So all of the ingredients for a sustainable recovery and a strengthening recovery are there. So whether it's one quarter or the other, from our perspective as long-term investors, doesn't matter too much.
Yeah.
I think one area to be thinking about over the medium term is what normalisation might actually look like. Our interest rates going back to 4.5%, 4%, 5%, 3.5%. There's a bit of a question mark around that, given the nature of the recovery, given perhaps some structural issues. One of the areas that the Fed Reserve President Yellen has been talking a lot about is the quality of the unemployment rate going down. And what she means by that is unemployment might be going down, but certainly the number of jobs that are being created are typically of weaker quality than you'd normally see in a recovery. So a lot of part-time jobs, casuals, the average wage is less. Indeed, wage growth over the last number of years has been weaker than you normally see coming out of recovery. So there's some underlying weakness that is being masked by the headline unemployment rate, which might colour the nature of monetary policy over the next couple of years.
What would be, impossible question coming up for you, what would be your gut feel on how you would see normal monetary policy playing out in America, as in where do you think rates are likely to normalise given where they are, from where they are at the moment?
Look, if you look at history, normal kind of suggests somewhere between 4 and 5%. Is where interest rates should wind up. But there's a lot of interesting stuff going on around the world. So how long it takes to get to normal is quite a different question. And when I say interesting stuff going on around the world, you've got Abenomics coming, continuing, and Bank of Japan has got its own quantitative easing program. Right? So they're busy buying bonds in overseas markets, including US Treasuries. We talked earlier about the weakness in the Eurozone, which is likely to provoke a quantitative easing program of some sort out of the Eurozone. And again, so weakness out of that market, money printing out of that market. You've got a slowing Chinese economy. Now, North America and the United States doesn't operate as an island. It deals with the rest of the world, and there'll be some feedback loops into how monetary policy and the nature of the recovery in the United States progresses as well. So I think you need to keep that in mind.
I think one of the other things, just to finish off on, is we're talking about America here, but there is an impact. People in Australia will think, well, that's got nothing to do with us. we live in a globalised world now, and very much so. So American interest rates are likely to have some impact on Australian interest rates, I would have thought. What's your view on that?
Oh, very much so.
Yeah.
I suspect Glenn Stevens and the Reserve Bank hope that there is a significant impact of rising interest rates. So typically, if markets behave as they should behave, when interest rates go up in a country, that supports their currency relative to other currencies.
Yeah.
So if interest rates go up in the United States, that should result in the strengthening of the US dollar relative to other currencies, including the Australian dollar, which means a weakening of the Australian dollar relative to the US. Similarly, a weakening of the euro relative to the US. Now that, of course, will be beneficial for our export sector and also should reduce imports a little bit. So you should see some import replacement, and that should be beneficial to the Australian economy.
And given that Australia is requires funding from overseas, if we're competing for capital with America, if they increase their rates, does that automatically mean that our rates have to go up to compete with that?
Look, the central banks do have a fair degree of control over the level of interest rates. That wouldn't be my primary concern. Markets are fairly liquid. The primary borrowers actually are the Australian banks, and they've got a very good degree of access offshore. The mechanism really won't play through in terms of increasing interest rates in the United States automatically meaning increasing interest rates in this country.
Right.
But there are beneficial impacts more through the currency mechanism.
Currency. That's really good information, and particularly relating back to how it affects us here in Australia. Dom, thank you for your insights. That's fantastic, and wish you well for the rest of the year.
Thank you very much.